Good day. My name is Mark Woodworth. I'm here in Atlanta, Georgia in early May, joined by my good friend Jack Corgel. Jack, welcome back.
Thanks, Mark.
And I know you and I both are somewhat saddened that our another good friend of mine and Jack's good friend as well, Rick 80, couldn't be with us. But Rick, we know you're watching, so we hope you're having a nice day. But enough of that. Jack, I was recently going through some older files, to say, and I found this report that you and our colleague Aaron Walls did back in March of 2007, and it was labeled the hotel supply conundrum.
It's kind of yellowed a little bit.
It's a little yellow, so I got to be careful when I put it back over here. But it did cause me to start thinking about what should we be concerned about levels of supply growth that then become troublesome for our industry. We've certainly seen that in studying past cycles. And one of the reasons I think we should begin to at least think about that is if we consider the fact that, again, the industry fundamentals continue to be very, very favorable, and the outlook remains very much the same for a protracted period of time. So in short, the case to support strong hotel profitability growth for the foreseeable future is a very solid one, which normally would say, okay, watch out, more hotels are going to be built. Are we going to see that this time or no? What do you think?
Well, we have been tracking well below the long-run supply growth rate for several years now of less than 2.1 or so percent. Our forecasts do have us moving up to somewhere near the long-run average, but there are probably four factors that will dictate whether supply growth moves beyond that point and kind of spoils the performance party that you just described. Number one is ADR growth, and we are seeing great real ADR growth in excess of inflation. So that's not going to be a limiting factor. It's going to promote supply growth. But as we mentioned in a previous video, hotel values are not increasing at anywhere near the rate of inflation. In fact, recent NACREIF data shows in the first quarter of 2013, they actually slid a little bit. The repeat sales indexes from CoStar and Cornell don't show any meaningful growth in hotel values. And the other thing that we've been, the report you referenced was all about construction costs, labor, land, materials. They are starting to kick up, and the forecasts from Moody's Analytics show those costs to be rising at a fairly rapid rate, reaching historic peaks, which was back in the 2006-2007 period, chronicled in that paper. Finally, financing, and financing is still pretty sticky, although we're seeing some light. So I think values and costs are going to be limiting factors on supply growth, moving much more than the long-run average.
Interesting. Makes a lot of sense. We're in the midst of updating our forecast based on the current Moody's economic outlook and, of course, first quarter data from Smith Travel Research. The initial findings are really that they're really not changing that much from where we've been. The outlook remains very, very solid. And it's not until I think it's 2015, thereabouts, that we get back to that long-run average level of supply growth.
Right.
So and certainly between now and then, if it's going to be opening, it's probably coming out of the ground now, or being ready to. So there's a pretty high level of confidence we can take today based on at least certainly the next year and a half. And as you say, the other fundamentals that feed into answering the question, should we contemplate lots of new supply or no, as you say, don't really suggest that today.
Right. I mean, what are your views on, what do you think the determining factors are on costs rising today?
Well, I think to a lesser degree, but I think it's certainly a parallel from what we saw in the last run-up in the mid-00s, and that was competition for supplies and materials. And back then, it came from the housing sector. Once again, we're seeing that particularly with respect to multifamily, and the Case-Shiller numbers from yesterday that we heard indicate continued very attractive improvement in home prices. So, again, that would suggest that, again, I think to a much lower scale, there is competition for those resources, and we know that therefore that has to drive up the price,
right,
and therefore make the challenge that much greater.
You've got renovation, you've got people investing in their existing homes, and you've got an uptick in starts.
Yeah,
so all those things.
And you mentioned, in wrapping up, you mentioned another good point in that that we certainly are seeing out there and believe this will persist, heightened levels of renovation activity.
Yeah.
Creating value with existing assets by repositioning the hotel. So, and there's, I think, a pretty strong case to be made that says, that's a very logical thing to expect given where we see industry fundamentals today.
Fully agree.
So that's it for this edition of Lodging Insights. Thanks again for taking your time, and we'll be back very soon with a more formal update of what our new forecasts tell us about the days ahead. So, Jack, thanks again.
Great.
And thanks again for watching.